Welcome everyone to this IFA Roundtable in partnership with Leveraged Equities. Just to kick things off, I thought I'd share with you some very interesting data that came out just 2 weeks ago from Investment Trends. It indicated that for the first time in 6 years, the margin lending market grew in 2013, up from 11.3 billion in December 2012 to 11.5 billion in December 2013, with a net year-on-year increase of 183 million to the total outstanding margin debt. So this may suggest that we're not the only ones having this discussion right now. Julie, you've written about this quite recently. Why is this an appropriate time? Why is this an appropriate climate in which to be rethinking gearing?
The expectations about markets is a key driver of any gearing strategy. So I think that there has been an increased confidence in about what the market is doing and a belief that the returns or returns have come back into the market. I think though that the current growth has got to be put into context. For me, what it represents is a return to normalcy. So a return to more sort of rational strategies about gearing in particular. This idea that, everything in moderation, including gearing, is okay. And what I believe is what customers are looking at.
To the rest of you, do you agree that you've seen this sort of shift in the last 12 months?
I think after a few years of poor returns, once the market started to move onwards, obviously it's a confidence piece. People started to see, okay, maybe the market's heading up. I've lost pace with where I expected to be at this point. Why not get on board? And with the interest rates falling, obviously that made for an attractive piece as well. So certainly they go together, I think.
So it's an interesting trend because in our own business, we've seen the number of people who've got margin loan facilities has decreased, but we've noticed the level of an increase in the level of activity, and so brokerage transactional revenues have increased. So it tells you fewer people are doing more, and that's probably makes sense because those are the people who are familiar with the product, are more active, starting to use it, and then you'll start to see it broaden out as other people start to regain confidence again.
At the same time, we can't deny that there has been this decline over some time. To those of you on the client-facing side, what are some of the main objections that you might hear from investors or from your colleagues, indeed?
Post GFC, there was a bit of fallout there from people who overextended themselves in margin lending space, and I think Julie's point there that we're now returning to a more normal approach to investing, a more normal attitude towards debt levels, is where we're finding a bit more resurgence in interest, because people understand there's a long-term game here, not a 5-minute short-term gamble, if you like, which may have been where margin lending was perceived previously. So I think it's a return to normal behaviour, really, normal investing behaviour.
We've seen a change in investors over the last few years, and there are several factors that have caused it. One is a record low interest rate environment that's occurred and looks to continue for some considerable time. The second part is, and probably the major reason we've noticed, is that gearing generally has changed now in the context of a lift in residential house prices, particularly in Sydney and Melbourne. That's given two impacts. One, in gearing generally in terms of asset lift. Where goes housing sentiment in Australia often goes the investor, and the second part of that is the affordability of households.
The point there that was touched on in terms of perception as opposed to market conditions. Interestingly, the investment trends data also found that despite this turnaround or slight turnaround, the demand for these products amongst retail financial advisors actually fell by 7% in 2013, with the demand seemingly being driven largely by direct investors instead. Look, Darren, as a client-facing advisor, what do you think is driving this disparity? Have investors got it wrong, or is there some sort of prejudice perhaps that's being harboured by financial advisors? Why is this different for them perhaps?
Well, I think there's still the hangover from the significant stress of having margin calls, and for a lot of advisors, I think they were experiencing their first margin calls in their careers during the GFC, so they have that memory hasn't faded for a lot, I believe. The other thing is, of course, that there's a lot more compliance around it now. There was a big lift in the disclosure and SOA requirements during the post-GFC period, so there's also a bigger hurdle we're actually putting in front of people. Certainly there'd be people out there with appetite for it, and I know a lot of advisors, it depends on their situation in terms of what kind of clients they see, but just being concerned about their own risk and the process they have to go through, I think is a big fence for them.
Idea that it's the perception rather than the reality. I understand from an advisor's perspective the need for more compliance, SOA requirements, etc. I believe that is correct. There was more this perception that from a customer's perspective, it was more complicated and difficult to get a margin loan. And I think that's slowly been proved to be incorrect, because we're not seeing any sort of additional paperwork or whatever. I do, however, agree with you that from an advisor's perspective, they have had the hangover from the GFC is still sort of lingering, that sort of doubt and concern about the margin call process and how to have those what can be difficult conversations with your customers, and I think also the SOA requirements and all of that extra compliance stuff. So yes, I think there are some hurdles there for the advisors.
Sure. I suppose the other thing is with part of these new requirements, although many say that there always has been one, but of course the best interest duty, the fiduciary duty, in the way that things are heading, would it perhaps be a breach of that duty to not consider gearing and to sort of rule that out as an entire sector?
Oh, I think so, yeah. I think you've got to be looking at a number of different scenarios when you're advising a client on a financial plan, definitely.
For me, it comes down to the goals of customers. I mean, it always comes down to goals. You always start a conversation with the goals. When you look at the sort of goals we're trying to achieve, and I'm not talking about the big ticket items like buying a boat or a fancy car or anything, I'm talking about your standard lifestyle, educating your children, buying your home, retiring comfortably, all of those things that we just expect naturally to occur. I think some of those goals are, or how to achieve those goals, are being underestimated by customers and advisors. Not just the big retirement question, but as I said, those other milestones along the way. It's a factor of, record low interest rates, great, but then on the flip side of that, that means, a term deposit isn't really going to be doing you very many favours on an after-tax basis. You're not really going to keep pace with, an expense like education, which is running at about 6% inflation. So you've got to come up with smarter ways of achieving those goals. And so I'd agree that best interest from a customer's perspective, either, if their goals are even just those modest things that we want to all achieve, you've got to find ways of being clever for them, how to get it, being sensible, being prudent, of course, but we're going to have to be smarter about how we do it.
It's interesting, just as markets have improved, a big part of the initial rally was people chasing yield. You mentioned term deposits on very low rates and that low rate environment continuing. So if a big part of the rally was chasing yield, it wasn't so much thinking about growth. The next phase of it does become, yields have stabilised, yields have been compressed in the market, we've got to start thinking about growth. How are we going to generate that growth going forward? Because it won't come simply just through a yield compression argument. So they have to then look at other strategies.
The amount of money that you need to start your retirement, given all of those questions about longevity, how are you going to actually manage all of that, when are you in fact going to retire, etc., I think make it a really impossible question for customers. Like, they don't know how long the piece of string is. And this is, I think, where some of the gearing strategies before the GFC were a bit of a problem. Because when you don't know what your target is, you don't have a measurable target, you don't know how much you need to save, then you possibly get into this cycle of fear of, I need more and more and more, and you become vulnerable to those perhaps imprudent gearing strategies, or imprudent any investment strategy, really.
I think you're tapping into some trends that we've seen at a high level across investors and across the entire space, and these trends have now become probably well established, but we're seeing a difference between aspirations in Australia and what people do expect, how they expect to live their lives. We talk a lot about Gen X and Gen Ys, and they all behave differently. I think people have understood that they do behave differently. We've seen a trend towards conservatism by investors, so they're not looking for double-digit returns. They're quite comfortable with a tweak above the bank bill rate. It's a far more conservative environment.
Some have suggested that this is actually, gearing is a good tool by which you can actually attract more Gen X and Y clients and retain them. What are some thoughts on that?
It also negates some of the reason too, because this is the great inheriting generation. So for a lot of them, they actually don't need to. So for them, they prefer to go out and spend the money. So they don't really have that long goal set. The group that's probably most interested in anything at the moment are those between, say, 40 and 55, because there's a great uncertainty about government regulation. That's been around for some time. We're going to see that play out over the next several months.
We're seeing people in the Gen Y to Gen X looking at self-managed super funds, which we didn't necessarily see that much 5-6 years ago. And this huge explosion in self-managed superannuation and this promotion of property and all this other stuff is just fascinating to me, because suddenly people are going, I'm happy to gear up hundreds of thousands in a property, but a little margin loan concerns me. It's a real misunderstanding of the issues. But it's raised the awareness. So you're seeing people come in saying, I've got the mortgage under control, the property might have gone up a bit over the last 5-10 years. What do I do from here? You know, and that the question being asked is probably more common than it ever was. So
the other part of that too is the generation, they're buying houses later in life, etc., as they've got to save up. Part of that wealth creation process to actually get to the point where you can put a deposit on a house is using other strategies in other asset classes.
That's right.
And I think that's one of the things we actually see in our businesses, where younger advisors working with younger clients who are starting out on the great journey are looking at these strategies and thinking about it a little bit differently.
I sort of disagree with Noel in a way. I think what Darren's saying is a bit more accurate, that I think the younger generation are more concerned, they're more aware, and they're more educated about the fear of not having the asset base at retirement. I think there's a far more, they've been bombarded with education and information on this sort of stuff. So,
And I think the idea of them being the inheriting generation, while I think in theory that's correct, and certainly the bequest intention of their parents is to pass the house to the Gen X's and Y's, the reality is that the longevity question is going to come into that as well. They're going to need the house just to fund their own retirement. And also in the aged care space, which is a very changing, higher demand space, the house becomes the entry price to look after your elderly parents. And that switches it from a growth asset into a basically a stagnant asset, So they might be thinking that, and that might be the intention of their parents. The reality is they may not see it. And I think you're right, they've had a lot of education. They may not be that engaged with their super, that might just go into the default fund and so forth, because they are concerned about changes to super rules, and they do have other goals before retirement, buying that house and having kids maybe and educating them and so forth. So they do realise that you have to have savings in other buckets.
The point that Darren raised about home loans and around drawing down from your mortgage, how much of a problem is that in terms of people going to that instinctively as perhaps an alternative to this strategy?
I'm always shocked when I see that statement of, just draw down your home loan to go into shares. And I know from a purely financial mathematics perspective, a home loan looks like any other bucket of money you're borrowing from a bank. But they are fundamentally different. And if we learn anything from the GFC is that they are fundamentally different. And a home loan to me is not a way to gear into other assets. The Storm financial situation, yes, admittedly a lot of those customers were inappropriately geared at maximum levels, so there were other issues going on there. But they had failed to recognise that when you have a home loan, the collateral for that is the home itself, not the shares. And a lot of people are doing this out of fear of margin call, which again I find really quite disturbing, to simply have a fear about some feature of a product and then going off and doing what is adding different types of risk to your profile without fully understanding that. Because if anybody thinks that a home loan doesn't have a margin call process and they haven't read the documentation fully, there is a capability for the bank to call up a loan. And if anybody hasn't learnt the lessons from Storm, then I think they maybe really need to rethink that. And this margin call process, if a margin loan is being used appropriately, that includes monitoring and acting. And the issue I find with most customers, and possibly some advisors, is they're less inclined to have that difficult conversation of, okay, if the strategy isn't going as we expect, if markets aren't performing, then we may need to look to sell out.
The margin call itself is only an issue if you are very, very heavily geared and markets move against you modestly, and that's when the process starts. But very conservative strategies, it shouldn't be an issue for most people.
If you're going to gear someone up, they should have a savings capacity to go along with it. So if everybody's, and it's also just melds really well with the whole basics of financial planning. You have a savings program. Try not to save it just into cash, because that's, as you pointed out, it doesn't do a lot for you. But have a sophisticated program of saving into investments, and a good little progressive gearing strategy that just teaches people a lot. They learn about sophisticated investment because they get to see the money dripping into something. They get to learn about gearing because it's happening in tandem with it, and they also get a habit of actually taking a bit of money and putting it into savings every month. It's just the basics are boring, but they work.
Going back to the issue of perception, which we spoke about at the beginning, we talked about the hangover from the GFC. A couple of people have also mentioned the Storm Financial case. What is it going to take for perceptions to change?
People just need that little bit of incentive. We're spending a lot of time in the education space, training advisors again, because I think there's been a lot of misconceptions about gearing as a strategy and margin lending, specifically. And so we're going back and just revisiting some of that and making sure that we're giving advisors the language and tools they need to deal with their customers. And I think that they are now prepared, or at least more prepared, to have some of those more difficult conversations initially about, this, if things don't go as planned, this is what we've got to do, you've got to be prepared for this. But yes, also, how are you going to achieve your goal? What are you going to do? And a lot more advisors are engaging in that, and customers are open to the discussion because they have got more confidence in the market.
We've had a number of advisors who, previous to the GFC, didn't need to be that thorough with their analysis of the investments they were putting their clients in. And the GFC exposed all that in a lot of ways. And I think a lot of them are having cause for pause, saying, well, I don't want to gear someone up, given their previous experience, gear someone up and then find that I just picked the wrong investment. So we're seeing ETFs become extremely popular because it's a good way to hide behind. I'm not saying it hasn't got its place, but advisors that don't want to be investment advisors, don't want to be thorough about the analysis and more perhaps the traditional broker model, they're kind of wondering, well, how do I hide behind this stuff with it while still trying to meet my client goals? So actually committing to a gearing program with people, for people that aren't actually being thorough about the investment selection, it's a pretty big risk.
In the United States, there's been some research that suggests a lot of what were previously known as advisors, RIAs, over there, they seem to be sort of differentiating into two camps now, which they call asset managers and asset gatherers. So they're very American terms, probably won't take off here, I'd imagine. But that sort of a mentality between working out your value proposition, am I an investment advisor or am I not? I think a lot of Australian advisors are going through that process, perhaps less explicitly. Would you all agree?
We've always been more of the joint approach on that the investment advice is pretty fundamental to getting the outcome you want. Yes. I don't think you can go there and stop. I think that's a full process as far as we've always been concerned.
But I think there is some structural shift happening in the advice market. I think that there's been so much consolidation going on. Some of those advisors, particularly under some of the bigger firms, the bigger banks or whatever, they are turning into more of just what you're terming asset gatherer, just that more sales process, I would say, as opposed to the holistic advice that, the firms around this table would actually represent. So I think, it is occurring, but perhaps not to the same extent as may be evidenced in America. And so I think, yes, most of the quality advice that's out there takes that holistic approach. You can't just stop at, go do a gearing strategy. I can't tell you what to invest in, because that often is the biggest question. Once you get over that initial hurdle of gearing, yes, it's appropriate for my circumstances. Okay, now what do I invest in?
We spoke earlier about changes in the customer, and we're also seeing changes in the advice environment. Very much towards the holistic advice and being an advisor. I mean, a lot of the other terms have all now disappeared. You either are an advisor in this space or you're not. And if you give advice, well, you've got to give advice. You're not there this partial process is no longer wanted by a client. So we've seen also a maturity of advisors. We've seen better education, and of course, for a younger generation of advisors, they're better trained, they're better backgrounds, they're tertiary qualified. So we're going through this whole maturity process, which is coinciding with change in client. Which one drives which? I'm not sure, but they're both going in the same direction. And out of that, you really do get some better strategies for clients, ones that do consider risk, one consider holistic gearing, ones that consider all of the issues. And that's what a client wants. They want to know, where does everything sit on the plate?
Post the GFC, some of our a number of our advisors saw referrals from their existing clients where they had friends who had that model where someone had just dumped them into a series of funds and it was a static model, no ongoing management. All of a sudden the world had changed and there was no one there to help them. So friends who'd actually been clients of one of our advisors had said, you need to talk to this guy, and it was a steady stream of new business that came along. And for those investors, it was actually a totally different way of investing, because they had someone who actually did want to build a relationship, understand what was going on, not just say, well, here's the model, that's what we're going to do for you, here's what we think, these are your objectives, this is how we're going to invest, and we're actually going to look at this type of portfolio, these are the securities we're going to include in it, whether it was a yield base for income or growth long term, depending on their stage.
That style of advice fits very well with how you manage gearing properly and appropriately. That whole monitor and act approach, not just leave it in the cupboard and forget about it, both on the upside and the downside, and the advisors that have that relationship, that transition to that better relationship is still an ongoing process. I think a more, long-term relationship is still an ongoing process. There's still a large number of customers who are maybe still, sitting with those advisors who've just plonked them in the model. Nothing wrong with that depending on their circumstances, but there's that shift to the more quality, holistic advice.
This goes with a theme that I think we're seeing, and that is it's active management. It's not only active management of a portfolio, it's an active management of strategy, it's an active management of risk, it's an active management of gearing. So by having a relationship, you can actively manage this entire process.
I think there is a real concern there, and it has been that more compliance-driven, if there has been an inappropriate advice given in the past, and potentially professional indemnity insurance is an issue, because often if gearing is a strategy in there. And I do have that concern that, gearing is still being used, but instead of doing it in the obvious way of a margin loan, it's getting shifted into that home loan, bucket. Not necessarily because they've considered the customer's situation, but just it, gets around some of those, problems that the head office might have, which is a real concern. I think that though those are being driven not by what clients want or expect, and is possibly why clients themselves are self-directing into the gearing, because their advisors aren't helping them to do that because of that overlay. So there has been really good moves, though, I believe, in terms of the risk profiling and the way gearing is used in the APL, but it is a slow process at the moment, and I believe advisors do have genuine concerns. And part of what we're doing in our education process is to deal at that, dealership level, the license level, to get them to better understand how to manage the advice that's going out in terms of gearing and what it looks like, and that active approach. Again, a lot of the groups themselves are still only moving to that active investment style advice which we've been talking about.
One of the trends that we've identified there is certainly one, advisors thinking more holistically and perhaps moving on from some of the cases in the past, but also this sort of direct investment trend, the idea that investors themselves are pushing for this. Is this something that we're going to continue to see?
Advisors that are aligned one way or another with product providers. That's always going to be a slower moving piece, I think. But again, as Noel pointed out, there's an education piece that's going on because of the freedom of information that's available.
The client will read something that may have nothing to do with the research that's been put out by their particular advisor, but then will actually ring for an opinion, to discuss it. And I think that's actually a really healthy position, because people then are actively engaging in the investment process.
It does come back to goals, it does come back to the economic environment and interest rates and all these decisions. And everything we've said so far indicates to me that gearing is a legitimate strategy. People are going to need it to achieve just even the normal lifestyle goals. Advisors are going to be driven by customers becoming self-informed and as you say, I don't know which leads which, whether it's the advisor or customer, but there is going to be a move towards that. And I think that holistic, full advice approach that we're moving to in many areas will naturally suggest that it goes into, or certain people will go into gearing. And I'm not suggesting we're going to see the great big run-up in gearing that we saw pre-GFC. I mean, that we've all agreed is probably wasn't particularly healthy in certain contexts, where it's a slow and steady wins the race sort of approach here. So it's really just going to, one, get customers back, get advisors back, moderate gearing, for moderate goals, not trying to win lotto by gearing up to the maximum.